Should a US LLC create a Canadian corporation for tax purposes? When a US LLC starts selling seriously into Canada, the big structural question shows up fast. Should you keep everything inside the US LLC and register it to do business in Canada? Or should you set up a separate Canadian corporation and run Canadian operations through that entity instead? There is no universal right answer, but the tax, legal, and administrative differences are big enough that you do not want to just guess. The first thing to understand is that Canada does not see your US LLC the same way the IRS does. For US tax, the LLC might be a disregarded entity, a partnership, or a corporation, depending on elections. For Canadian income tax, the Canada Revenue Agency's long-standing position is that most US LLCs are treated as corporations, regardless of their US classification. That tax mismatch is one of the reasons cross-border planning often points you toward a more deliberate structure for Canadian activity. Canadian subsidiary versus Canadian branch of a US entity. You essentially have two broad models for operating a real Canadian footprint. One is a branch where the US entity itself is registered and treated as carrying on business in Canada. The other is a Canadian subsidiary, which is a separate corporation incorporated under Canadian federal or provincial law and owned by the US parent. From Canada's perspective, both a Canadian branch and a Canadian subsidiary are taxed on their Canadian business profits on a net basis, after deductible expenses. A branch may also face a branch profits tax on after-tax earnings that are effectively remitted back to the US parent, while a subsidiary pays corporate tax and then its dividends to the US parent are generally subject to withholding tax, usually reduced under the Canada-US treaty. Economically, branch versus subsidiary is often closer than people expect once you run the math. Why many US businesses choose a Canadian corporation? Even when the pure tax result is similar, many foreign investors prefer to carry on business in Canada through a Canadian subsidiary. A corporation incorporated in Canada is deemed resident in Canada for income tax purposes and is treated as a local company. That can make contracting with Canadian customers, dealing with banks, leasing premises, and hiring employees simpler because you are not constantly explaining that you are a foreign branch. A Canadian subsidiary also ring-fences Canadian business risks. It is a separate legal person, so local liabilities are usually contained in that entity rather than sitting directly on the US LLC's balance sheet, subject to guarantees and thin capitalization rules. For groups planning a meaningful physical presence in Canada, this combination of local credibility and limited liability is often a decisive non-tax advantage. From a compliance standpoint, the Canadian subsidiary files its own corporate income tax returns and handles its own GST, HST registration and payroll accounts. The US parent then just reports its share of the subsidiary's after-tax profits on the US side, subject to foreign tax credit rules and treaty limits, when keeping only a US LLC might be enough. If your Canadian activity is limited and you do not yet have a permanent establishment in Canada under the Canada-US tax treaty, you may be able to treat early Canadian sales as cross-border exports rather than full local operations. Under the treaty, Canada generally only taxes business profits of a US resident where those profits are attributable to a permanent establishment in Canada, such as a fixed place of business or certain long-running service projects. In that early stage, your main exposure may be indirect tax rather than income tax. If you are considered to be carrying on business in Canada for GST, HST purposes and your Canadian connected taxable supplies exceed the $30,000 small supplier threshold, you may have to register for GST, HST even without a corporation in Canada. In that case, you register the non-resident LLC with the Canada Revenue Agency, obtain a business number and program accounts, and charge GST, HST on your taxable Canadian supplies. That kind of non-resident registration can work well if you are selling digital services, low-touch consulting, or drop-shipped products with no Canadian inventory or staff. As your footprint grows, the branch versus subsidiary question becomes harder to avoid. Permanent establishment and real presence. The treaty definition of permanent establishment is your main switch between exporter and local business. Article 5 of the Canada-US Convention defines a permanent establishment as a fixed place of business through which the business of the enterprise is wholly or partly carried on, with examples such as an office, branch, factory, workshop, or place of management, and special rules for construction sites and natural resource projects. There is also a deemed services permanent establishment rule that can apply where services are provided in Canada for at least 183 days in a 12-month period for the same or connected projects. Once you have Canadian offices, warehouses, or long-running projects that meet these thresholds, the treaty will treat you as having a Canadian permanent establishment even if you have not formed a local corporation. At that point, you are effectively running a branch for income tax purposes with obligations to file Canadian returns and pay Canadian corporate tax on branch profits. The LLC classification problem. For US LLCs in particular, there is an additional wrinkle. Because the CRA generally treats US LLCs as corporations for Canadian tax purposes, but the US may treat the same entity as a flow-through, the result can be misaligned tax timing and in some cases, double taxation if the structure is not carefully planned. This is one reason some advisors suggest either using a straightforward US corporation for cross-border work or forming a Canadian corporation to hold and operate the Canadian business, rather than pushing everything through a hybrid LLC in Canada. So should you create a Canadian corporation? Creating a Canadian corporation rarely makes sense just for the sake of appearances. If your Canadian revenue is small, your activities are low touch, and you clearly fall below both the small supplier threshold and the treaty permanent establishment tests. In that scenario, non-resident registration for GST, HST, and careful tracking of your treaty position can be enough while you test the market. Once you start storing inventory, signing leases, hiring staff, or putting dedicated infrastructure in Canada, the argument for a Canadian corporation becomes stronger. You get clearer liability separation, a simpler story for Canadian customers and regulators, and a clean Canadian taxpayer that can be bought, sold, or financed on its own. From a tax perspective, you move away from the ambiguities of branch attribution and LLC classification and into the more predictable world of Canadian corporate tax on Canadian profits, plus treaty-reduced withholding on dividends. Final thoughts. A US LLC does not automatically need to create a Canadian corporation the moment it makes a sale into Canada. But if you are planning real operations on the ground, recurring profits, and long-term customers, a Canadian subsidiary is often the cleaner, more sustainable answer. The decision sits at the intersection of tax, liability, and admin complexity, so it is worth modeling before your Canadian revenue takes off. If you want more step-by-step guidance on when to stay non-resident and when to incorporate in Canada, you can explore our website for deeper cross-border planning resources. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.